The year has gotten off to a very strange start.
So far in 2026, emerging markets are up around about 6%.
There's more to the world than simply just investing into America. The market will tear your face off as much as you think, okay, I think I know what I'm doing, but it has a great way of humbling all of us.
An important thing to look at for this year is not getting too distracted by noise.
Do you have a prediction of how the NZX might do, and then also who may be in power come post-election? Well, 2025 was a very strange year, but many investors fared well. And today we're going to find out what we can expect in 2026 with a very popular guest from 2025, Greg Smith, an investment specialist from Generate. Good to see you again, mate. You were popular last year. Hopefully we can live up to the hype.
Well,
this
that's
year.
good. God, yeah, it's something to live up to, isn't it? But yeah, hey, great to be back, and I hope you had a great holiday. You're looking pretty rested.
Yeah. I think I feel rested. I'm not sure. But anyway, I'll tell you, the year has gotten off to a very strange start, just like 2025 was, and there was sort of no rest for investors with all sorts of random things happening out there straight away, right?
Oh, absolutely. And we talked about how, just recapping out how crazy a year it was last year. I mean, it was extraordinary, wasn't it? With Liberation Day and tariffs and everything that sort of could happen seemed to happen, yet the markets did really well. I mean, the S&P was up around about 16% for the year. Nasdaq was up around about 20%. And yeah, a lot of investors, I suppose, do focus on America and what that did. But there was some other markets that had some even more amazing performances. So I was just looking through this the other day that Europe did really well. The stock market in Spain was up 49%.
The Spanish stock market.
Yeah, so
can Kiwis
a
access
raging
that?
bull.
Yeah, raging bull. Can Kiwis access that some way?
Yeah, they can. They can access that through through various sort of brokers and stuff, and also we through fund managers who we have exposure to Europe and Generate's funds. Yeah. So these are markets that can be accessed either directly or a more diverse way through through fund managers. And just to point out that Spain's had a pretty rough time over the last sort of 5 years, some sort of cherry picking a little bit there, but it's been a volatile market. It was the Spanish banks that actually did pretty well last year. And you often find when you those big headline grabbing returns, sometimes you need to, obviously you always talk about past performance being no guide to the future, and you need to look at the longer term sort of picture. So I think probably get better. And the other interesting one I thought from last year as well was technology had a great year, and we know the Magnificent Seven did well, and Nvidia and all that, but the Kospi in South Korea was up 76% last year. Again, it's highly unlikely it's going to do that again this year. But there was some standout performances globally. But when you look at that biggest market, S&P 500, very, very strong year.
That was actually something I was going to ask you about too, and we'll go straight there because for a lot of us we're new to investing. We might even only be, well, I shouldn't say only, but we're in our first 5 years of investing outside of, say, Kiwisaver, or maybe taking more of an active interest in it. How much are Kiwisaver providers and investment specialists going, it's great that we focus a lot on America and we have a lot of media attention about it. We're constantly talking about Trump and we're looking and everybody knows what the S&P 500 is, and not that long ago maybe they didn't. But going, there's more to the world than simply just investing into America?
Oh, for sure. And I suppose there's a lot of focus on America, not just because Donald Trump's one of the more sort of vocal presidents we've had in history, but it is the world's largest economy. Yep. So there is certainly that. It's one of the most powerful economies in other ways as well. And the stock market is probably one of the most visible. And I suppose historically it's been, after New Zealand and Australian markets, it's been a market that's been able to be accessed by sort of New Zealand investors. But it is worth, like this old saying, what I talked about that last time about not having all your eggs in one basket. And the US economy or US stock market isn't the be all and end all. And I suppose one point there, we have got quite a high concentration now when you look at those mega cap technology stocks. They're accounting for around about sort of 40% of the S&P 500 when you look at some of those bigger trillion-dollar names. So that is something to be wary of, and it did set investors very well this year, but you can't guarantee that that's going to happen again in 2026.
Because I even saw Ray Dalio in a post recently came out and said he had a lot more context to it than this, but basically money left the US for Europe, China, Japan, and emerging markets all outperformed US equities. So as much as we're kind of learning, the US is a a great place to invest. Some of these people that have been playing the game a little bit longer are going, yeah, but there is more that you can be investing to, and talking about how it's interest rates that can determine that, or money looking for a safer home or a different place to invest. So yeah, I think we're all on a learning journey, and I don't think it ever finishes.
Yeah, that's for sure. And I suppose it is about concentration as well, concentration risk, And when something's sort of had a big run, nothing in the stock market persists forever or ad infinitum. At some point, there's always, a correction, or whether it be a small one or whether it be something not so small. We saw a relatively sharp one in Liberation Day last year when Donald Trump held up that board of tariffs, but then things recovered pretty quickly, didn't they? So it is certainly worth looking at that. And you make the point about emerging markets. I mean, so far in 2026, emerging markets are up around about 6%. So it's been a really strong performing area. As to whether that'll continue, remains to be seen. Emerging markets present a lot of risk, or can present a lot of a risk. Actually, look at Venezuela. Who would have thought that you'd have the president of the United States orchestrating a sweep for that country's president, and that's obviously changed things around massively. So, a lot of emerging markets in South America, for instance, you're dealing with hyperinflation in some cases. So, vastly different to what we're dealing with. But Asian markets also present something different as well. So Japan is up around about 6% so far in 2026. Again, you've got things to deal with there. You've got a snap election potentially happening. You've got the Bank of Japan it's got rates at the highest since 1995, albeit they're only 0.75%. They've struggled with deflation over the years. So lots of different things to consider. And I suppose the wisest thing for investors, whether they're new or even sort of hardened investors, is to remain disciplined, to think about diversification and not concentrating too much in terms of risk.
Well, you mentioned banks before, and something that I spotted last year that I thought was quite fascinating. I'll show you this one, for example, like Westpac here. They are up, that's over the last year, they are up 27%, I believe it is. And then I started searching ANZ share price as well, and some of the various banks, and they've all had an incredible run over this last year. And it just jogs my memory of a story that I thought you might be interested in. You'd be very disgusted in me, Greg, is that when I was a young fella, and probably in my 20s, I was probably leaning more towards that I reckon I can, outrun the stock market, and I think I should be timing my own Kiwisaver. So I had this theory that Westpac sort of always goes up to kind of around 30, then it drops back down, then it goes back up, then it drops back down, then it goes back up. So I thought, well, I'll just self-manage my Kiwisaver, and I'll just basically get out at 20, and then, get in at 20, get out at 30, and then wait for it to go to 20. And I tried that, and it basically then I think I hit this period where it didn't really happen, and I thought, what am I doing here? I should not be doing this. I should be focusing on trying to grow my income and leave this to the specialists to be doing. But I think it highlights that when markets are going well, it is very easy to sort of constantly look over the fence and go, oh, there's a better return over there, maybe over there. Or I could have, if I just invested into Westpac for the year, I could have bet the S&P 500, so maybe I will actively manage my own. And I can see where that trap becomes very easy to fall into where markets are doing well.
Oh, for sure. I think a bit of a lesson there is staying invested for the course, and then trying to be cute when obviously you think about who's looking at these stocks, and I suppose someone doing it at home with spending an hour a day on it or 2 hours a day, maybe that might seem like a lot, but it sort of pales in comparison to I suppose the analysis that's going on by the stock market as a total, right? So sometimes those things can work for sure, and that but sometimes you've also got to take the rough with the smooth. Spoken to people in the past who have a rule that if this is not so much pertinent now because markets have been doing very well, but having a stop loss policy where if a stock goes down 20%, you cut it. Yeah, that's fine. You can do that sort of thing, and you can do that sort of strategy by all means. But don't be sort of too. You can't be too concerned, I suppose, if you get that situation. I've met people that have where a stock might go down 25%, and then for whatever reason it turns around and it's up, 50, 60%. So you miss out. So nothing wrong with having, I suppose, a hard and fast rule, but you probably got to take the rough for the smooth. But I suppose the importance, I suppose, over the last year, and I think this is again another lesson for this year, and you're talking about sort of looking at technicals and certain levels and timing, that's one thing, and that's sort of hard and fast. I think the other important thing to look at for this year is not getting too distracted by noise.
Yep.
We saw a lot of that last year, as we talked about. We had those people perhaps that sold out around Liberation Day and said, I know better than this is not for me. Would be feeling pretty crook if they were sold out of their US equities, looking at things at the end of 2025. And I think you're going to get more of that noise, a lot more of that noise potentially in 2026, maybe even as much as we got last year. We're only 2 or 3 weeks into 2026. We've had the Venezuelan president captured by the US administration. Donald Trump wants to basically own Venezuelans' oil reserves, which are the largest oil reserves on the planet. We've got President Trump wanting to buy Greenland.
Yeah.
Understandably, NATO members aren't too happy about that. He's then said, now I'm going to put up tariffs by 10, 15, 20%.
To those countries.
I think there's seven member countries that he's talked about. We had all that trade war stuff last year, and then we finally had the agreements. I think the one with Europe was in around about August. Is that all going to be unwound? That might be something to deal with once again. And then on top of all that, we've got what's happening with the Federal Reserve as well. So there's a lot for people to digest, and it'd be easy to be knee-jerk in terms of the reaction. So I think that's going to be something again for investors to be very aware of this year. Not get too distracted by all the noise.
I think as well, like remembering what you're investing for, and I think that's something for me where I think a lot of younger people now are learning about platforms that you can go and you can buy your shares, which is all good and well, but you can also log in the next day and sell them like straight away.
That's
and
right.
Back when I first started investing, there's a lot more friction and it was more expensive. So it was sort of, you would go, you know what, I'll just write it out. And it sort of created that. But now it's very easy to see a news article and go, well, I can actually jump in there and I can get out now, or I can sell. And I'll show you this one, for instance, and I think we'll probably talk about, we just talked about emerging markets, but I was consistently buying these emerging markets. You can see there, those dots there is me making purchases. And then I decided, it's not really doing anything. And if anything, like if you zoom out, you can see it's actually kind of drifting down. So I keep dollar cost averaging in. And then I decided, bugger it, I might sell and just do something else. Well, then lo and behold, since selling them all, you can see what's happened to the price of that. So I think I kind of get out at around $1.30, and now they're sitting at an all-time high of nearly $2. So I actually miss all of the upswing because I decide, I've been dollar cost averaging as the price is going down, but now I'm just going to sell it all and nearly sell at the bottom. And now those emerging markets are doing really well. So it is the market, I think, the message there, the market will tear your face off as much as you think, okay, I think I know what I'm doing. But it has a great way of humbling all of us, I think.
Oh, for sure, yeah. And don't look back in anger everyone sort of goes through lots of these sort of situations, and we could probably recount sort of dozens of stories between us. But just learn from it. I think that's the thing. It's a good all part of the experience.
Too many of us signed up to a Kiwisaver plan without much thought. And signing up is great, but if you've never got advice before, you could be missing out. Your Kiwisaver account could become one of your biggest assets over your lifetime. That's why getting expert advice early and ensuring you're in the right fund is so worthwhile. Generate have a team of Kiwisaver advisors available to help. Head to generatekiwisaver.co.nz/change to book a no obligation meeting. They can even come to you. A copy of the product disclosure statement is available at generatekiwisaver.co.nz. The issuer of the scheme is Generate Investment Management Limited, and of course, past performance does not guarantee future returns.
So let's turn to New Zealand. What's your sort of outlook, or what do you see coming this year for New Zealand? Like a better stock market, we've got an election, there's recent announcement of a free trade agreement for the longer term that we might feel some impact from into the future. What do you see sort of playing out in our local market and maybe some of the CEOs and stuff that you might be bumping into?
Yeah, it's interesting. And like last time I was along, a few months ago, we talked about how tough it was in the New Zealand economy, and we talked about how, things might be getting a little bit better over the next sort of 3 months or so. And lo and behold, things actually are getting better. It's still tough for many. And, the New Zealand market, if you just were invested in that, relatively disappointing when you stack it up against the US markets or Europe or Japan and the like. It did have a positive performance. the New Zealand market did actually hit a record high last year.
Yeah.
And hey, we've got one of the most dividend-heavy markets in the world. So you get, investors would have got a good dividend, and would certainly have competed with what you could get elsewhere on term deposits when you factor in that positive return. Again, selectivity was important as well, because you had some standout performances, last year from likes of Freightways and names like that. So it was possible. Fortunately, a stock that we had in the Generate funds, but it was possible to actually still deliver a strong performance. But overall, if you just invest in that New Zealand market passively or for an ETF or something like that, or the whole market, it was a pretty small, frustrating single-digit performance.
Yeah.
But the backdrop against that, the economy was tough, right? Really tough. But we've had a few more things sort of go our way. We've had. And we talked about this last time as well, about the transmission effects as interest rates are lowered. So our central bank progressively through last year lowered rates, and the time it takes to sort of filter through the economy is due to a few things, but partly when you look at mortgage holders, most people tend to fix their mortgages for 2 years. So you're on a 2-year, you got a year and a half left to run, and central bank cuts rates next month. That doesn't really help you. But as more and more people come off, that filters through to the economy, filters through to consumer spending, then filters back to businesses. So I think we've had sort of a number of positives, should I say. And the green shoots, I was trying to think of a better cliche, but I'm not sure there is any. But those green shoots are, I think, starting to push out of the soil now. They're really sort of manifesting into that. So since last time we had the GDP number, so we bounced back in the quarter. So remember, we were down around about 0.9% the previous quarter. We bounced back over 1%. That was much stronger than expected. More recently, business confidence, that's hit an 11-year high. Things are still tough for a lot of businesses, particularly small businesses, but businesses are becoming a bit more optimistic about the future, about what they're seeing and about what they're seeing near term. So order books, that drives things like investment, employment as well. So we're starting to see that. And some sectors are really going well, like manufacturing growth. The PMI recently came in at the highest in 4 years. It was a really positive surprise. So, we are starting to see some positivity come through. I think the other interesting thing looking at this year is we're going to have some more transmission effects with the Fonterra payout. We're going to have $3.2 billion paid out to Fonterra farmers. That's going to wind itself through the economy. We're going to see obviously more of the interest rate lag effects come through as well. So looking ahead economically, we think New Zealand's going to have a much better year. It might be weighted in terms of the real gains to the second half of the year. And, possibly, I suppose, looking at it from the market's point of view, most are saying that, we can get to that in a minute, but the Reserve Bank isn't going to probably cut again. I think they'll maintain that optionality, and maybe they don't need to, but I think they should probably hold for the year.
Two things. One, the Fonterra piece is going to be interesting to watch play out. This is starting to get a little bit geeky, but there's a bit of a perception farmers will pay down debt, but maybe they'll invest into their farms, or maybe they'll draw some money out to pay themselves from how hard they've been working. But given it's a capital sale, there are specific tax rules about those funds leaving the business without overdrawing your shareholder current account. So I think a big winner in that is going to be the rural accountants around the country. Look for them to be driving nice European cars by the end of the year, figuring out how they can get that money out to the shareholders personally. But I was going to ask you, with interest rates decreasing, are you guys noticing and are you hearing around the traps where baby boomers perhaps who have had TDs, and I think we might have 230 billion sucked into term deposits, people saying, we'll bring it out and we don't want a 3% term deposit or a 4%, if you can even get that now. We might look at some investing into dividend-paying stocks in New Zealand. Like, are we seeing that? Or is that me hoping that might happen?
Absolutely, already seeing that. And you were seeing that towards the tail end of last year. So people are coming off those higher term deposit rates, realising that they're gone. They're not going to be able to get those in the current environment. So where else can they put their money? And so cash isn't paying as much as it used to. And for sure, we've got a number of options. We've got obviously a very dividend-heavy stock market. We've got yields on offer there. We've got a more appealing macroeconomic environment as well. We've got some great companies that people can invest in. Of course, they can also diversify offshore as well. But yeah, we've seen an increasing number of, since probably last couple of months of conversations around that, and people going, just literally coming to us going, hey, we realise that we can't get what we were getting in the bank. Where else can I put my money?
Because I suppose as well, like, there's probably an education piece for some of us with parents who have grown up around property and term deposits and those two asset classes, sort of only safe as houses, okay, TDs, the bank will never go under, we're going to be fine. But, there is, I guess, an option to explore investing into funds and then just drawing down slowly on it and accepting, okay, there may be some volatility, but, if we're doing this over a long term, that's also an option rather than just, okay, we need to be investing into companies that pay a good dividend and that gives us our passive income. So I feel like with this massive wealth transfer and now decreasing interest rates, this education in this space is going to speed up because these people are going to start seeking advice.
Oh, absolutely. It's already seeing that as well. So people appreciate that. It is taking a long-term view. If someone wants to come along and invest in a stock tomorrow or a fund tomorrow and take it out next month, they're sort of spinning the roulette wheel a little bit, to be frank. But, if you're taking a sort of medium to long-term view and looking at the consistency that, the stock market has delivered in terms of returns over a longer period, and this is not just New Zealand, but this is globally, it's quite appealing. I suppose the natural inclination, in recent decades has been for property versus shares. That's probably still quite a big trade-off. I think if you look at the property market in New Zealand, is it going to do anything near what the stock market might do this year? I'm not so sure about that. Still, property prices are still really elevated when you look at it on a global scale in New Zealand. And I know Kiwis love to own bricks and mortar, and when it's your own home, that absolutely sort of makes sense. But I think in terms of obviously returns, the stock market certainly sticks its hand up.
Well, I think if the capital growth in property isn't there, then the, what do you call it, operational return of a property, people start to question for the effort required. So it could be, okay, interest, costs are coming down, which is great, but, rents haven't been able to increase, so you're not driving an increased margin. But also the frustration, the curtains have come down. Well, what used to be a couple $100 and maybe fix it yourself? I think we live in I'll ring this person, get them to do it. Oh, that's $1,500. You've just eaten into your profit for 3 months of a rental. And I think there's a bit of maybe I'll look at some of these other investments. I think as soon as that capital growth, if it does return to property, the Kiwi regression to the mean will go, that's easily the better. You could do it with leverage. But I guess we'll get to watch that play out.
Oh, I'm sure you're absolutely right in terms of rent growth is moderated, and just whether that effort is sort of worth it. Of course, we're going to talk about looking ahead as well. We are in an election year, and who knows sort of what's going to happen.
Do you have
with capital gains tax? There's clearly going to be a conversation, and they've said the first home is going to be sort of off limits, of course, and so on. But how does that sort of ramificate around the rest of the market? And then, of course, the other one, in addition to capital gains, is what happens with conversations around Kiwisaver.
So we're not holding you to these predictions, but if you would like to, do you have a prediction of how the NZX might do, and then also who may be in power come post-election?
Okay, because we're going to play these back, aren't we, in 11 months' time. Yeah. So, look, I think... and this is, I suppose I should not
financial advice, of course.
Not financial advice, of course. But I think the incumbents will probably remain the incumbent, remain in power, sort of come the end of the year. Look, there's going to be a lot of conversations, as there will be, in the US. The US have got their midterms issue as well. Cost of living, is still a pretty big issue, and that's fair enough. It's been a big issue, and when sort of people look at election comes around and they look at, hey, are they better off or worse off than last time around? Cost of living is definitely going to come into it. So that will be a bit of a hurdle. I suppose it's going to be about who does the public believe more in terms of things getting better from here. I suppose interest rates, we talked about those transmission effects earlier. So the rate reductions that we've had, we're going to have probably another 20-30% of the mortgage pool come off onto lower rates by the time the election runs around. So people might be feeling a little bit better about what's going out of their bank account each month for the mortgage. Some inflation is starting to moderate. In fact, we had some food inflation numbers out recently, actually fell in the last recorded month. So, which is, everyone's used to, God, you just go to the supermarket and it seems like you just get a few bits and pieces and you're spending $100 on your debit card. So, things are starting just to be a question of whether that's whether that's enough. So that's on the election. In terms of the stock market, I would probably be a bit more confident that we'll certainly be quite a bit higher, I would have thought, by the end of the year, come the NZX. And if we had a sort of fairly modest gain last year, but I think factoring in dividends, we should be looking at potentially a double-digit gain over the course of 2020.
All right, we'll hold you to the double digit.
2026, yeah.
The other thing I forgot to mention before, what I think could be slowing the New Zealand economy down, and we touched on this last year too, but I heard it recently, and I thought this was quite a really good example where a young person was saying to me they've got $1 million worth of debt, their interest rate went from 5 to 8, and they were basically like, wow, this can happen. So there was lesson one, but now they've been burnt by that. They've managed to realign to being able to afford that 8% interest rate or near on there, and now they are like, well, we're going to keep our repayments the same, and they are watching their mortgage decrease in terms of the term a lot faster. And I think there's a bit of that happening where younger people that have taken out debt and have had their first economic shock of, sheesh, I thought interest rates only went down. That's recency, bias of what has been happening to, I'm going to protect myself, where instead of, going out and spending and having a, holiday or whatever they're going, I'm going to retire some debt because I didn't really like that feeling of being so stretched, which is, I think, probably a hindrance in terms of, the government or whoever wanting us to get out there and spend. For that group of people, they're going, well, I think I've been burnt. I'm gonna clear my debt first.
Yeah, I'm sure there'll be a degree of that. And again, these are all sort of learnings, aren't they? I suppose. And those that when COVID hit and we had rates going down to next to nothing, and people thought it was a great time to spend and a great time to overextend themselves on a house and then they're painful learnings, aren't they? But I think you're paying down debt, not necessarily to zero, but paying down debt, in the current environment makes a degree of sense. But obviously, you also got to balance up, what you could get on the other side, what your debt costs are, and what if you didn't pay down that debt, you could potentially earn.
Well, that's also one of the questions I'm starting to see pop up more now as people ask me, hey, should I pay down my debt or should I invest? So that becomes the dangerous thing once you started learning about investing too and reading about 15% returns and 16% S&Ps and Korean stock markets and whatnot. You're going, well, actually, maybe I shouldn't pay my debt and maybe I should invest the difference. But that's, I think, a very individualised answer for people. However, the fact that people are asking that again, I think shows as soon as debt gets to an acceptable level in terms of price, people start to look, okay, where's my arbitrage, if we want to use that word, or more plain language would be, how can I make $1 from this dollar that's only costing me this? There's got to be a smarter way to get it working for me. So the fact that people are asking that, I think, is a bit of a sign that people are coping with the interest rates that they're paying.
Yeah, great conversations, and great to have that sort of awareness and showing your listeners and your viewers are becoming a lot more learned thanks to you.
Yeah, I hope so. Most Kiwi don't have a financial plan; they have a "she'll be right, mate" attitude. Amy from Leverage is helping KTC listeners change that. If you're needing direction, clarity, or wondering what your next financial move should be, then book a call with Amy or download her free DIY financial plan to freedom. To do that, visit financialplan.co.nz. Well, I think with an election coming up in New Zealand, this is going to be one of the first times for some time where I think just about every party is going to have to put their cards on the table of what they want to do around Kiwisaver. And the overall theme seems to me that there's more encouragement to do it, but also to encourage Kiwi people to contribute more, and maybe we're going to see that become more and more compulsory and those rates increase.
Yeah, that's right. I mean, we are starting to see them ratchet up, aren't we? So, look, Kiwisaver's been great for New Zealand. It's approaching, we're coming up to 20 years in terms of the anniversary, so maybe just time for a bit of a reset. So, we're edging up from sort of 3% up towards sort of 4% over time. But I suppose the big question is it enough? Most Kiwis, I think, if you really sort of looked at it as to whether they're adequately prepared for retirement across, and obviously, it differs depending on what segment you're looking at, but the answer is probably no, not. We probably don't save enough to live We could probably save enough to live maybe a no-frills retirement in some cases, but to live a comfortable retirement, one that you deserve, probably requires a bit more. We've got 30% of people that could be or should be contributing to Kiwisaver, they're not contributing. And really sort of missing out potentially, and not just because they could have their the funds with a Kiwisaver provider and earn money on it, but literally squirrel stuff away for for their retirement. So I think it'd be interesting to see what the conversations are around contribution rates, and also in terms of being compulsory or not. So many moons ago, there was actually a referendum on whether Kiwisaver should be compulsory. I think it was back in the 90s, might have been earlier than that. But
so not Kiwisaver, but the then version of that?
Version of that. Yeah. So superannuation should be compulsory.
Yeah.
And it was like 91 or 92% in the negative. It was just basically viewed as a bit as a tax.
Yeah. Why? Okay. Yeah. Because I was going to say, like, obviously I wasn't around in those days, and that surprised me that 9 out of 10 people were saying, like, no way, like, we shouldn't be saving for our retirement, or maybe they're not wording it that way. Like, why was the public so convinced that it wasn't a good idea to invest for the future?
Yeah, my understanding was just viewed as a tax without sort of and perhaps not framed the right way. And I think that a lot's sort of changed since then.
Imagine the wealth of the country if that had been the other way.
Yeah, and you need to look at obviously Australia for they've turned themselves into an absolute powerhouse in terms of their superannuation pool. It's obviously set up quite a bit differently in terms of New Zealand's, but it's been great for that country. It's been great for the underlying wealth of people and the future retirement sort of savings for that. So that's, if anything, a bit of a blueprint that New Zealand can look to as to why we should perhaps have a higher contribution rates. Bear in mind Australia's at 12%, and something that's compulsory. Obviously, if raising the rates, there's an impact to businesses, and as we said earlier, that's a lot of businesses are still doing it tough, so you can't just sort of do that carte blanche. So there'll have to be conversations around the incentives there and what that all looks like. So it's not a straightforward answer by any means, but
it sounds like we're more willing to have the convo across all political parties. It was a bit like, that's boring, we're not looking at that now. I wonder, part of me thinks that sort of once Kiwisaver got to $100 billion under management, it all got taken a bit more serious because the snowball was just going to roll, so much faster. And I think we all sort of know that through saving a certain amount of money, where all of a sudden the gain on that is, well, actually that's quite, noticeable compared to a smaller amount where you go, okay, well, it's great. You get 8% on $100. Okay, it's $108. But, it's a lot different to 8% on $10,000 and then 100,000 or $1 million, or obviously in this case for Kiwisaver, 100 billion. So I think from the 1st of April, we're seeing default increases to 3.5% already, with choices for 4, 6, 8 and 10 still available, and then 4% from 2028. Do the Kiwisaver providers, do they start modelling out, okay, the potential difference of that 0.5% plus then the match from the employer to go, okay, how much faster does this grow the pot?
Oh, absolutely, and it's pretty powerful. Yeah, we're talking the power of compounding. So every dollar extra saved, it might not seem much, but adds up a lot over time, and you can be talking tens of thousands, if not more, in retirement. So it's a meaningful amount, and I suppose it's like anything. If you're that 1% might not seem much. But if you don't put into your Kiwisaver, then you're probably just going to go and spend it, and that will sort of have utility now because you spend it on something. But in terms of having future utility for your retirement, it won't be there. So
I feel like there'll be a frustration between the 2 million that are doing something and then the million who aren't, and there'll be a bit of a, well, I wasn't and I couldn't, and easy for you to say. And then there'll be an expectation for them for the state to provide or somebody to provide, and then you're going to have 2 million people going, well, this is shit. I sacrificed the spend in the short term to set myself up, and now I'm being hindered by this, or now I'm subsidising this. I feel like if we don't get this sorted soon, it's going to get out of control.
Yeah, it certainly needs to get it right, and that's a great point as well. I mean, it not only eases saving for retirement not only eases the burden on ourselves or whoever's saving, but the government and ultimately taxpayers. And the government pension for, it certainly is nowhere near what's probably needed for a lot of people to live a comfortable or retirement or one that they deserve. So, but it does place a burden on the government and the rest of people. So I think probably the key thing is you need to consider your own situation. Like, not worry too much about whether you're paying for someone else sort of down the street, but figure this as it's saving for your retirement. It's going to give you a bigger nest egg, and it's going to give you the ability to leave a decent retirement. And and we're all living longer. We all want to live better in our retirement, and sort of, I suppose, soak up all those years of working and enjoy it really, and
have choices as well. And speaking of choices, I was speaking to somebody recently. They started their investing journey, and I said, look, don't, if you don't have time and you don't want to go down that rabbit hole, just don't. Just go to your Kiwisaver provider and find out what managed funds they have outside of Kiwisaver, so that you can just carry on living your life. And I think some people don't realise that a lot of the Kiwisaver providers do actually have funds outside of the Kiwisaver offering where they can set that up as well. Mine and Generate was really simple to access the thematic fund, and then just start, investing into that, and it can do its thing rather than, all right, now I've got to go and pick this stock or sign up to this one and figure out how it all works. And I think it's the piece that I like about what's happened with the advancement of Kiwisaver too is that these providers aren't just doing Kiwisaver. For a lot of them, they are then giving individuals like myself access to other funds that I can access at some stage if I want to. I don't need to be 65, and it's very simple to set up because they normally, they in the case of Generate, have all of my data and info. So basically, right, I just go through this process and then I can be investing into a managed fund alongside it.
Yeah, absolutely easy, and it's easy to do. And there's a host of funds there, not just Generate, but a variety of providers. And literally, when you're all set up, it's important. We do stress it's always important because there's such a choice to get advice, because certain funds might not be appropriate for certain people. So if you look at our diversified funds, they'll have a different mix of growth and income assets. So it's really important. That's what we believe. It's really important that people do get advice and make sure that they're in the right fund. But there are a host of choices, including single sector funds. You mentioned the thematic fund, and perhaps we can go through a couple of our themes in a minute. But that's been a really strong performer consistently. Over the years, it's done really well. Top down, big picture view on themes that that we believe are going to do well over the next sort of 12 to 18 months and longer. We've got another global fund, we've got a trans-Tasman fund, we've got fixed income funds, we've got cash funds. So variety of choices, easy to do, just important to get advice to make sure you are in the right fund.
One of the Generate advisors can talk people through that, I'd imagine.
Absolutely.
Yeah. Absolutely. Okay. And speaking of themes, so themes, where do we go with themes?
Well, so we're not going to give the total game away because we're going to maintain some IP, but I thought I'd start with, there's been a lot of conversations around AI. Is it a bubble? Is it going to burst? If you get now into AI, are you sort of last person on the bus type sort of thing, or the last person at the party, or perhaps the first person at the party with the biggest hangover if it sort of all comes to an end. But we think the distinction between winners and losers is going to be more apparent this year. So again, that's probably a good case of being more selective rather than just having a broad exposure to everything in tech land. And also, just on that subject, we talked a little bit about this last time when you talk about having a diversified portfolio. It doesn't mean having 30 technology shares. That's not a diversified portfolio.
My bad.
So distinction between winners and losers. Look, I in many ways, we're still just at the cusp of things in terms of AI. These companies, a lot of these big companies are growing at pretty strong rates. We're talking sort of 30, 40%, so they deserve to be rated a little bit higher. But just splitting out some of the themes in there. Power, AI, or what do you use? What's your go-to in terms of
Chazza, I call it. ChatGPT.
ChatGPT, likewise. So that's great, but whether it's that or whether it's Claude or something else, they all use huge amounts of power, and that's why the hyperscalers are building data centers and the like. So power generation, energy infrastructure, they're going to be continue to grow in terms of servicing the tremendous power requirements of AI and building reliable power at scale. So that's certainly an area we like. Another one would be robotics. And
Robotics.
I know Elon Musk, he thinks that, basically everyone's going to have a robot in 10 years' time and jobs will no longer exist. So not sure if we'll quite get there, but it'll be interesting to see. He's got his Optimus, I think. That's it is a robot. Maybe he's been watching too many much in the way of Transformer movies, but do think robotics seriously for automation, basically for reducing costs, and basically just for making businesses and the global economy more efficient is something that's only going to continue. So automation, we see as a key thematic as well. Interestingly, if you look at sort of the growth that's coming globally, a lot of that is actually being driven by improved productivity. And I have to say that, even if you look at AI, I mean, I don't know about you, but I find my productivity is good. Things you could do, 100%. In a few hours used to maybe take a few days, depending on what it might be. So if that's happening to you or me, then it's happening to a lot of people globally. So a lot of the economic gains we're seeing are being driven by productivity improvements. I think the US, it might be after this goes out, but the US GDP is out soon. The economy is expected to grow around about 4.3% over last year, but productivity growth is around about 4.9, I think it might be. So we're seeing greater productivity gains. Unfortunately, that's also meaning that labour growth isn't quite keeping up, with the economic growth. So there's a bit of a disparity there, but also disinflationary. Also another sort of, I suppose, tick in the box for investing in stock markets, and also another point about why the future growth that is to come means that maybe global markets aren't actually that overvalued at all. If you look at the S&P 500, it's on around about 23 times earnings. So automation, another one that's perhaps not really related, but sort of is in a way, waste management.
Waste management.
Yeah. So
okay.
Trash is, obviously we've got recycling, and we do our best to put our stuff in the right bins. And actually, some councils, I found this out sort of being Christchurch over the holidays, that some councils actually give you a ticket if you put the wrong recycling in the wrong bin, which I thought was interesting. But
wow. I actually saw one of the councils, and I won't name them, but you can probably dig this out. They tracked where the recycling ended up. So you put it in the council-provided recycling bins, and then they tracked the recycling to see where it ended up. And I'll tell you what, it ended up next to the general waste. But anyway, sorry for another day.
But yes, look, serious issue. The population is growing. We're living longer. We're creating more waste. We're doing our best to make sure it's recyclable waste. But global waste volumes are going to increase at this current rates 70% by 2050. So there's going to be a bunch more waste. Land is obviously, there's only so much sort of waste you can sort of bury under the ground. And so I think recycling, recovery, and waste to energy solutions, which sort of goes a little bit to what we're talking about in terms of power, could be a big thematic again over the coming years. So that's sort of three we're looking at. And robotics, as mentioned, could have a bit of a breakout year.
Well, I noticed that even on the NZX, there's a smart automation and robotics ETF, and I've been keeping an eye on it. And I think if I show you the graph of this one, it's also looking pretty sharp. But everything's looking pretty good these days, isn't it?
Yes, it is. It is.
One that surprised me too, that may be of interest, and maybe they'll need some of this equipment to deal with all that waste. But Caterpillar, the diggers, etc.
Yep.
Have you seen their stock price? Far out. It is
bananas.
Yes.
Yellow bananas. Yep.
Yeah. Just absolutely wild. Some of these,
Caterpillar is one of those bellwethers, isn't it? I mean, big earth-moving equipment, and if they're doing well, it's a bit like cranes in the construction industry. If it's like cranes around the construction industry is doing well, if they're doing well, then that's a good sign, for the global economy. And I think back to we talked about the New Zealand market. In terms of and everyone likes making these predictions, don't they, this time of year? And I think it's great that you come back and towards the end of the year and actually held people to account rather than just sort of letting it fade away. But global markets perhaps might not go in a straight line this year, but our base case is that the global economy does okay. The US economy doesn't see a recession. And you've got this productivity stuff going on as mentioned, but the economy's proved to be pretty resilient. Jobs numbers have been a bit weak, but Americans are still spending. They haven't had the same issues, have they, with the mortgage holders with what we've had. They're locked in on their 30-year mortgages, so they've held together. Pretty well. So borrowing costs though are coming down as well. That's good for companies. I think just on that point, we've got, I suppose the other interesting point about this year is we've got a new Fed chair, right? So
Jerome will be changing at some stage this year.
in May this year.
And what I'm seeing from the outside, from my limited understanding of the space, is it seems like the president is pretty keen on interest rates decreasing to then bring down the price of debt to maybe then pump the stock market as well. But he seems pretty keen to see interest rates decreasing.
And a number of, I think, two key reasons. So one, in polls for what they're worth, there's lots of people, you believe polls, you don't. But his rating, President Trump's ratings at the moment are pretty terrible. He wants to improve those. There's the midterm elections towards the end of this year. Like any elections I talked about before, people are going to look at, how are they living? What's the cost of living doing? And, that is going to be relevant, despite the fact that obviously, mortgage holders are on 30-year mortgages in the US. So he wants to get rates down. That's a good sign for the economy. And that should potentially sort of help him in the polls. The other thing he's sort of looking at, not just rates through the Fed, but he recently came out and said, which I sort of actually can side with him a little bit, double-digit credit card interest rates. He wants to put a cap on those. I think around about 10% or something like that, which I've always struggled with that. Why you pay sort of 20%, 25%. Yeah. It's almost like loan shark rates, isn't it? But that's a conversation for another day. But the other reason is as well, when you look at the government's own finances, so the record debt. Yeah. So the interest line on that debt is the third largest expense item, only behind Medicare and social welfare. So, you're talking sort of trillions is being paid away. Yeah. So he wants to get that down for 2 points. So you're quite right. Wants to get more rate cuts through, and obviously there's always been these awkward moments last year between Powell and Trump and various other officials. But now it's got a lot more confrontational, given what's happened recently. So the Department of Justice is investigating Jerome Powell for comments he made to lawmakers last year about the refurbishment of the Fed's HQ. It's pretty crazy. So
that's never happened before, right?
No, that's right. I think it's around about $2.5 billion they're spending on their HQ. So it's pretty nice, pretty flash.
Yeah,
I like this.
This wasn't a $2 billion budget.
But I think he's gone. They've got over about $750 million. So Powell got up in front of the Senate and talked about why that was. So they're claiming that he misled, and he's claiming it's not about that. And a lot of people appear to agree that it's more about pressure to trying to get him, to cut rates. But then people go, well, he's leaving in May. What's the big deal? So is it because he's sort of being punished, or there's probably two other possibilities. One is that while he has to retire as Fed chair in May, he can stay on for, I think it's till 2028 as a governor.
Oh, wow.
So he could potentially be sitting there. He gets one vote, but he could be trying to influence things, and obviously he's quite a well-known guy. So maybe they're worried about that. Or the third possibility, is it genuinely about accountability? I suppose that you could play devil's advocate and say it's that. And then it was actually reading a bit about this over the last few days, actually, about just the structure of central banks, and they don't have CEOs. That's probably the point we're pointing out. So the Fed chair is effectively the CEO. So the buck stops with them. So depends on which way you look at it. You could probably make an argument each way. But it would seem that Donald Trump and the White House wants to get rates lower.
Well, a couple of things to wrap up, and one of those is from what you're telling us, and a lot, I think, in this podcast, there's more uncertainty to come. So for Kiwisaver investors, for investors in general, no matter what age, like what do they need to be thinking about, given that we just seem to live in a time where you can go to the news and there's a new thing that's never happened before, and there just seems to be so much more uncertainty than ever before.
Yeah, there'll always be something that comes along that wasn't expected. That's life. and that happens in the markets as well. So I think it's important to not get too rattled, and by all means, take note, but just get the right advice. Don't panic, because again, we talked about that lesson just from a year ago, or actually April last year, so 10 months ago. That when you sort of panic, sometimes like anything in life, you can perhaps make not the best decisions. So be educated as well. Get good advice, but also get the awareness that you can be disciplined. Think about the long term. I think that's what we say to all our members. If you, particularly on the Kiwisaver side, it's retirement wealth is built over decades, not months.
Yeah, and I think as well, a simple analogy I use is like if your kid's having a tantrum in the supermarket, you're going to be pissed off in the moment, you're going to want to sort it out there and then, but realistically, it's not going to be the thing that stops you investing into that child.
That's right.
You're going to accept that this is the volatility of having a toddler, of having a child, of giving them too much sugar, what it may be, but you still love them and you're still going to invest into them because you're thinking long term.
Yeah, that's right. And actually, I suppose, with the stock market, much like when you've got a kid that's well behaved, for a while, it's easy to get complacent. So there's going to be a point, whether it be in the next few weeks, the next few months, or at some point this year, whereas something's going to come out from left field potentially. So it's important again not to react too much to that and get the right advice. But already we're into a year, 2 weeks. Look at we've talked about what's happened.
Oh.
So it's going to be as interesting a year potentially, but also without being sort of too negative about it, also a potentially fruitful year again if you're invested right, and that's I suppose what it's all about ultimately.
I love New Zealand, so we'll finish out with a couple of things on New Zealand and just interested in your take. I think I've never seen more Kiwi people understand that money's losing its value, or that something's sort of fundamentally like wrong with money, where it's I need to be investing because I'm getting shafted. Things are becoming more expensive. My wages aren't keeping up with inflation. I feel like this last 5 years could have been one of the best education periods for Kiwi people to learn more about money, interest rates, inflation, economies, taxes, all those sorts of things. And it'll be interesting to see if the conversation carries on, which I'm sure it will as we start to talk about capital gains taxes. So just your thoughts on that, but then secondly, on that as well, interest rates, do you see them being, the official cash rate, do you see it being higher or lower at the end of 2026?
I think it'll be the same.
The same?
Yeah.
Yeah.
So I think, look, it was interesting just before Christmas because a couple of banks actually put up their, a few of the banks actually put up their mortgage rates on the view that swap markets are basically saying the Reserve Bank is done with rate cutting. So, as mentioned earlier, I think the Reserve Bank's probably maintaining some optionality. We've had some encouraging roots pushing through the soil. Things are looking a bit brighter, but they might. I think they'll sort of maintain an ability if the recovery doesn't prove as sustainable as they thought, that they might actually cut rates one more time. Yeah. But the base case is that they remain on hold, through this year. I think we're seeing we've got a lot of spare capacity in the economy, so we're not off to the races yet in terms of our economy at all. So it'll take some time. It'll be sort of a healing process for the economy through 2026. That shouldn't stop the stock market doing well. It's forward looking. So I think the base OCR rate will be thereabouts where it is at the moment. Though we certainly wouldn't see it going much lower. At maximum, it will be one more cut. And also, it's important, and probably Japan's a notable exception, but central banks tend to move relatively in lockstep, tend to err on the side of caution. We've got a new governor, of course, who's already in place, so it'll be interesting to see how sort of she leads things. We've got a relatively new team, but I don't think there's going to be as much work to do on moving rates around a lot as there perhaps was over the last sort of 12 months. I think there'll be other things to sort of deal with, but look at the US, and we've got to maintain our awareness of what other central banks are doing. Markets are pricing in one more rate cut in the US this year. I think they'll get two, particularly with Donald Trump wanting to sort of get things downwards. We're seeing some inflation sort of playing ball at the moment in the US despite tariffs. inflation's starting to play ball here. Rents, it's been a big source of inflation. He's talked about that. Food prices have started to go down.
Yeah.
The currency, we've got to be aware of that, how the effect it has in terms of inflation. But I think stay around about where it is sort of at the moment, and that'll be conducive to our market potentially doing quite well this year. And for sure, I think there's been lots of learnings over the past 5 years, as you mentioned. No one would sort of want a repeat of that in terms of COVID and obviously recession, trade wars,
Inflation,
everything, right? Just an absolute myriad of stuff sort of thrown at people. So hopefully a bit of smoother sailing. I think things are looking better for the economy in New Zealand over the next sort of few year and beyond that. Better for the stock market as well. But don't take learn. We can all learn from what's happened over the last 5 years. We're all even the most professional fund manager out there makes mistakes. You won't get it right all the time. But sort of how you learn from it. I think that's the key thing, as you were talking about with your example earlier.
And complete tangent, but do you like soccer at all?
I do like soccer, yeah.
Okay, you got a tip for us for the World Cup in 2026?
Oh, actually, I was watching, funnily enough, last night, maybe prepping for this, I was actually watching the last episode of Wrexham, so I think that was fascinating. And not to spoil where they are at the moment, but I think that'll be interesting to see how they go in the remainder of this. It's been an absolute sort of fairy tale story, hasn't it? Always feel sorry for England. I lived for England for 17 years.
17, did you? Yeah.
There was always, actually lived right near Stamford Bridge.
Oh, wow.
And then moved out once had kids, but all the way around the sort of the Fulham, across the road from Fulham at one point as well, and that's probably a bit more of a family conducive ground to go to.
Yeah.
But the English have put up with a lot of hurt. I'm losing count now what it would be. Is it like 50 years of hurt?
Yeah.
It must be something like that. But
You'll be rooting for England.
I don't know about that. I do like the South American teams as well. Argentina has probably historically been the team I'd sort of like watching the most. So
maybe Argentina.
We'll go for them.
Yeah. I did also try and search the odds for the New Zealand election, but we don't offer those odds in New Zealand, but they do in Australia, but we can't access Australian betting sites anymore to check. But I might have to try and dig those out, and I'll give you an update off the mic as to what the bookies are saying at this stage of who's going to win the election. But mate, by all accounts, it sounds like we're in for another year of surprises, uncertainty. But realistically, what I always try and remember is that these businesses, and these leaders, they're all thinking about the same thing. And they're having to deal with it, and they're trying to beat inflation. They're trying to get their shareholders' returns. They're innovating. They're trying to stay ahead of trends. They're trying to understand how AI is going to impact their business. They're trying to understand their numbers. And what I do like about investing is you get to put your money into their hands to a degree and go, okay, well, you guys are the leaders and the players in this game, and I get to be a small player in behind, getting some of those gains from the good work that they're doing.
Oh, absolutely. And I think it's and you're quite right, the professional money managers and market managers are spending, hours and hours and hours. So, 40, 50 hours plus, a week just on this stuff, living, breathing, sweating it. So, when you're as a private investor, perhaps thinking, I can just beat these guys, it's tough. Maybe you get the success stories that you'll hear about. You always hear about the success stories, but if you're spending a few hours a week and you're dealing with in terms of Kiwisaver, your life retirement savings, it's worthy of perhaps more than that. So I think by all means it's really important to understand where your money is. I think that's great to understand whoever it's with, what is it invested in, is it in the right investments for me, am I in the right type of fund. But it's also good at time to be able to sleep at night, maybe a bit better to leave it to the experts in terms of the actual nuts and bolts of it. But great to understand what's going on. I think that's really important as well. And all for investor education increasing.
Well, thank you for making the time again, Greg. And I believe that a great listener reached out from the bottom of the South Island, great place, Invercargill.
Yes.
I believe, and offered your boy a job, but that might have been a little bit too far to go. Is that right?
Yeah, absolute shout out. And I'm from the South Island. I grew up in Oamaru, so it's actually not too far away. He's maybe another month or two, he might be tempted to sort of move down there. So I actually love Invercargill. Great vibe down there. They've got a great velodrome. They've you got the Bluff oysters. So yeah, thank you very much to your viewer that sort of reached out. That was very, very kind. My son had a couple of conversations with him, so you never know. He might be moving down to the deepest south and supporting their stags maybe one day.
Yeah, how good. There we go. They had the Ranfurly Shield during the last season, didn't they? Looking for a job as an electrician, right?
That's right. Yeah, apprentice. Yeah, that's right.
Cool. All right. Well, maybe if there's a job closer to home, then get in touch with Greg. If people do want to get in touch with you, how do they do that?
greg.smith@generatekiwisaver.co.nz. And obviously you've got my mobile number as well, but I'll leave that with you.
We'll chuck it in the show notes. And we'll have you back on the 31st of December to check in to see if you got this right or not.
Awesome. Really look forward to it. You have a great year too.